listening to the Real FI Podcast, where we discuss time-tested tricks, techniques, and strategies for pursuing financial independence today so that we can enjoy a better tomorrow. Financial independence isn't about getting rich quick. It's about cultivating a foundation to grow financially, mentally, physically, and spiritually. Let's figure out how to kick the 9 to 5. Here are your hosts, Patrick and James.
How's it going, everybody, and welcome back to the Real FI Podcast. I'm your host, Patrick McGrath, with my co-host, James Ripion. How's it going today, James?
It's going well, Patrick. I'm super excited about today's episode. We've got a kind of unique guest for the types of episodes we've done in the future. Today, we're talking about something unique and new. I think it's going to offer a diverse perspective to our listeners to kind of start thinking about in finances and greater macroeconomic subjects in a different light. So with that, we've got Logan Bolinger here. He's going to talk to us about Bitcoin and all that exciting stuff. But before we get into all that, Logan, why don't you tell us a little bit about your background and just give us a little bit of history on yourself?
Sure. And thanks, guys, for having me. I'm excited for our conversation. I'm pumped to be here. A little bit of background about myself. I am an attorney, practicing attorney by day. I do a lot of work in the Bitcoin space by night. I'm kind of an unlikely, I guess, finance person. I coming out of college, I wanted to be an English professor, went to grad school in Chicago, got disillusioned with that path, ended up being a high school teacher for a few years, got a little disillusioned with that, went to law school, was a lawyer in Chicago for a few years. Now I'm in Maryland and kind of in the process of moving myself full-time into the Bitcoin space, but straddling careers at the moment.
That's awesome. So why don't you tell us a little bit about what you're doing on the side outside of your lawyer work, and maybe give us a little bit of the history as to kind of what led you down the path to being interested in Bitcoin.
Sure. Yeah. So I think similarly to Patrick, my Bitcoin journey started in 2017. That was when I first encountered it. I was in law school at the time. And it didn't really stick with me. I think most people, it requires multiple touch points, multiple encounters. It was certainly that way for me. I didn't fully get it, I don't think, in 2017. And, I had some, sold some, and it wasn't until 2020 where I kind of got back into it full swing, dove in. I think March, April, May of 2020 was a huge turning point for me, just in general, for my kind of personal finance journey and how I was thinking about personal finance and how I was thinking about the economy. And so I really dove down the monetary policy rabbit hole then, and that attracted me to Bitcoin. The Bitcoiners seemed to be the only people talking about that at the time. And so I started speaking and writing publicly about Bitcoin in mid 2020, I think, and started writing a newsletter called Think Bitcoin almost exactly a year ago. And so that comes out, it was going out every week, and now it comes out every 2 weeks because it just takes a long time to do. And so I just recently incorporated Think Bitcoin. And, I'm looking to sort of build a Bitcoin education company and kind of expand the ecosystem, sort of make a platform for education. I think there are a lot of gaps to be filled. There are a lot of demographics, I think, that are kind of looking for a quick way to be educated on Bitcoin. And, there's just a lot of noise out there. And so I'm attempting to be kind of signal amidst all the noise and hopefully help some people get on board. And so that's what I'm spending all of my off hours and weekends doing now, coming home from my lawyer job, trying to hit the switch button in my brain and kind of move full Bitcoin.
I can relate to your story almost, spot for spot. Like I first heard about Bitcoin in law school. It might've been like 2015, 16. Didn't buy any. Thought it was really dumb internet magic money. Had no purpose, in this world. But at the same time, everything seemed to be going well economically on the big picture. So I had no need to learn about it. Fast forward 2018, you got this speculative bubble going on. Bitcoin's going from like whatever low it was up to $18,000. Decided, I'm savvy investor, I could probably trade this a little bit. Bought a little bit at the top, lost, good bit of money that I had invested, probably $3,000, I don't know, something like that. Not a lot, but at the time, a lot. And then fast forward to 2020, like I'm looking around at the world, COVID's happening, world shutting down. I'm looking at the stock market, again, thinking that I'm smarter than your average bear, thinking that the market's going to keep going down. But, all of a sudden we hit this like inflection point in the stock market where it just starts to rally in the midst of massive unemployment, things not looking great, economically. And, it became a turning point for me personally. And, I can kind of relate to you in that way, in that respect. But, with regards to Bitcoin, why don't you kind of just give us a, broadly painted understanding of what it is. Like, what is Bitcoin and why is it significant?
Before you get into that real quick though, since we're all kind of talking about when we learned about Bitcoin and how we kind of all invested, just to give the audience an idea of, the three of us and where we're all coming from. I actually found out about Bitcoin back in like 2009, 2010. So at the time I was going to a lot of raves. I was a DJ, and one of the promoters was accepting Bitcoin as payment for his tickets. Because he, like an outlaw. And I can remember that so much. And I think at the time, it was like a couple dollars. But I was like, oh, this is too complicated. And why would anyone want to do this? Like, then fast forward 2017, I had watched a documentary about mining, Bitcoin mining and Ethereum mining. And my neighbor was a gamer, and I was like, hey, we should start mining Ethereum. And at the time, I think Ethereum was $30 a coin. And within the span of like 2 or 3 months, this is like March to June, July timeframe, it shot up to like $250, $300. And at that particular point, I was like, this is ridiculous. Like, I need to figure out how to buy this. I downloaded Coinbase, put my debit card in, and within 24 hours, I was purchasing crypto. And I was like, this is insane. Like, I did not think it was that easy. So, of course, I start buying. Prices are shooting up all the way through, the end of 2017. So I get the bug to build my own miner. I'm like, screw that. So I started watching some YouTube videos, bought a mining rig with 3 graphics cards, and it was going pretty good. So I got 6 more, and I bought more and more and more. And at one time I had over 50 graphics cards in my basement mining Ethereum. And then fast forward into early 2018, as the three of us know, that's when the market starts to so Bitcoin goes down from 20,000 all the way down to 3,500. Ethereum tanks, Litecoin, all of the cryptocurrencies tank. And, I look like the dumbest guy in the world. Sold off majority of my crypto, held on to some, and then right in 2019, December 2019, I probably had at the time maybe $2,000 worth of crypto that I had left, and the market was going up, and then it took a nice dive right before Christmas, and I said, not again. I am selling. And I sold everything December 2019, and as we know, 2020, 2021, everything skyrocketed. So I am absolutely a terrible cryptocurrency investor. So the HODL method, I think you are going to point down to us on why that makes the most sense. So like James just said, can you break it down for, laymen like myself and why it's important, what it is, and all of that?
Sure. That was an incredible story, by the way, Patrick.
A lot of lessons learned there, let me tell you.
Yeah, it was. I know you guys discussed in a previous episode, Patrick, you guys have sort of different risk appetites, and you're kind of I'm going to go out there and I'm going to take some risk, and I'm just going to kind of sort of figure it out as I go. And James, I think you were saying in a previous episode that you're kind of a little bit more conservative and sort of when you get in and kind of get out of things. So that was interesting. And yeah, so To answer, that's a big question. Kind of defining Bitcoin, it's always hard to do every time I'm asked to do it. Bitcoin is, it's so many things, and I usually try to meet people kind of where they are and in a way that is the most relevant to them, because it is such an interdisciplinary thing. I think where I'm kind of starting now, where I usually start to explain it is it's just money. And I think people should think about it as money. And I think they should think about it as sort of the best monetary technology for storing value, which is what money is, across time and space, storing value across time and space. That's sort of the best technology for doing that humans have ever seen. And if you sort of study the history of money, money is it needs to have certain qualities, and Bitcoin possesses those qualities better and sort of in a stronger way than all previous forms of money, which I know is going to sound probably insane to some of the audience who are going to talk about volatility, and we can get to all that. But what I mean is, I think you guys, and talking about real estate all the time, that Bitcoin is digital. It's money that has digital scarcity. It has sort of provable, verifiable scarcity, which is something obviously that gives, if you're buying land, you're buying properties, you're buying buildings, that's stuff that's, it's harder to make more of them than to simply sort of hit a keystroke. If you're somebody, you're trading at the Fed and just creating paper money, or what we would call fiat money, which is just, for listeners, money by decree that's not backed by anything. We create that as a country out of thin air. And so I usually try to start with people to say, think of Bitcoin as money. It's money that cannot be manipulated. It's money that no single person or entity controls. It's also kind of a transaction. It's a network, and you can transact with anybody anywhere in the world. I could send money to Bitcoin to somebody in the Ukraine right now. They would get it in like 10 minutes. It doesn't, it's a kind of the removal of middlemen, the removal of kind of banks who are verifying transactions. Instead, everything is being verified on a blockchain, which is just kind of a big long chain of transactions. And those transactions are getting verified by, I don't want to get too technical, but by what are called nodes, which are people running the Bitcoin software all around the world. So you can't shut Bitcoin down. Nobody in the U.S. government, you can't ban Bitcoin. It'll just move. It's kind of unbannable unless you shut down the internet across Earth. And even then, there are ways to transact without the internet. So, but I would encourage folks, if you're kind of looking at Bitcoin and thinking, oh my God, this is all kinds of technology and terms and weird computer science stuff, just think about it. Just start with the concept of money. It's a way to store value. Everybody who's investing in real estate, in some way you're trying to store value, and you recognize that that's a better place to store your value than paper cash. And so Bitcoin is just another sort of way to do that, but it's superior to gold for a number of reasons, superior to paper money for a number of reasons. But at the end of the day, it's money.
So let's dig into the history of money a little bit, because I think that might give people a little bit better of a context of the shift in what money used to be and what it has become. And we don't have to go too far, into history and give all these crazy examples of what used to be money, whether it's like African beads or, seashells or rocks or whatever. But, maybe let's start in like the 70s and what money meant at that time and what it's kind of transitioned to be today, as far as it relates to gold, fiat, and governments.
Sure. So historically, for most of human history, money has been backed by something or just is the physical commodity of some kind. It's only very recently, 1971, 72 to be exact, that our money, the global reserve currency, which is the US dollar, ceased to be backed by anything. We're no longer backed by gold. We were sort of backed by gold before 1971 when Nixon decided to take us off. But the reason Nixon took us off was because we no longer had enough gold to back all the sort of claims on gold that were dollars out there around the world, because we had, to print a bunch of money to fight the war in Vietnam. And this is kind of a story as old as time. Countries have to fight wars. Well, they don't have to fight wars. The countries always do go fight wars. And every time they do it, wars are really expensive. And, World War I, World War II, countries were just falling off the gold standard left and right. At the end of World War II, the only country that, wasn't kind of rocked by conflict on their soil was the US. And so we had also been loaning money to everybody in Europe. So we had all the gold basically. And so we kind of had a period between World War II and 1971 where we kind of had this hybrid system. It was called Bretton Woods, where just a bunch of countries came together at a place called Bretton Woods and decided that that basically, the US dollar was going to be pegged to gold and every other currency was going to be pegged to the US dollar. And that gave the US what the French president called at the time, this kind of exorbitant privilege around the world. And but eventually the wheels came off that because we started spending more money than we had gold to back it. Other countries started to get a little nervous. They were like, oh, we don't know if we can exchange these dollars for gold anymore. France famously sent like a battleship to the US to collect their gold. And so Nixon just shut the gold window down. I was like, okay, there's no more redeeming dollars for gold. We're not doing that anymore. And so from that point on, we entered this period of history that we're still in that's completely unprecedented, really, until now, where we are kind of, the monetary system now globally is what's called the petrodollar system, which is sort of complicated, but is basically just, we have agreements with countries in the Middle East where they price oil contracts in dollars and we defend them. And that creates a big demand for dollars, allows us to run up our debt cheaply for the most part. So, up until kind of relative things are, recently. I would argue things are changing. I mean, the last 10 years, foreign buyers are not buying as many treasuries. They're not buying our debt as much. So that's kind of created the biggest, buyer of US debt now is marginal buyer is the Fed, which is not a good situation when you're kind of buying your own debt. So yes. And so Bitcoin is kind of just this, Bitcoin emerges in, 2009 and is sort of a response to all of this, to this kind of new era of money where it's not backed by anything. And it's kind of, when it's not backed by anything, you can manipulate it endlessly. And that's what happens. And that's kind of part of why we've had so many booms and busts in the last 50 years. And so Bitcoiners are kind of trying to take us back to a more of a sound money standard.
Yeah, so, I mean, go ahead, James.
I was going to say, describing how the Fed is basically pumping up our balance sheet with debt, just to put some layman terms on it, it's kind of like taking out credit cards to pay off other outstanding credit card debt that you already have. And you're robbing Peter to pay Paul. And kind of in the case of the United States fiscal situation, monetary situation, it's robbing future generations to pay off current debts of existing generations. And I think, when I first came across Logan, when I was reading a guest post that he had online, it was called Bitcoin, Millennials, and the American Dream. And it did a great job of kind of dissecting the financial situation for millennials and why Bitcoin might just be an alternative financial asset for those looking around, kind of questioning like their financial status relative to like prior generations. So I'm sure we'll get into all that, but fundamentally what I think we have is like a monetization of assets. Like the dollar can no longer mean what it used to because it's not a good store of value. And anybody who's been looking at the markets recently, well, maybe not the past couple of months because we've been going down due to the tightening of the Fed, but like prior to that, the expansion of monetary policy and fiscal policy, people have been, in our space specifically, fleeing to real estate to store dollars, and you've been benefiting greatly from that. But yeah, I mean, I'd really like to get into kind of what your thoughts are with how Bitcoin could be used as a tool by millennials and younger generations. But Patrick might have a different route he wants to go at this time.
No, I definitely want to go to that route. I also just want to include into this that currently, with the last 2 years with the pandemic, as well as China and Russia have signed agreements with Brazil, with Iran, to start transacting in oil outside of the US dollar. So not only is the dollar getting hit by the rampant quantitative easing and printing of money, these other countries are going to start transacting outside of the dollar, which means that we are going to lose even more of our power, basically, monetarily, as well as they're saying that Japan and majority of Europe could actually be facing a huge recession where the Fed is going to have to start printing money for them, which is going to cause inflation elsewhere inside in the world. So we have a very big monetary problem globally happening. So I think what Logan is about to tell us is going to help us mitigate our risk for those things. And I see him smiling over there because he obviously was thinking that as well.
You're hitting all the right keys, Patrick.
Yeah, and I mean, you guys, you both, bringing up good points and fascinating topics to discuss. I'll start with Patrick, because I think what you just described, Patrick, is something that I think is just wildly criminally under discussed in the personal finance space. I'm not sure if you guys agree with that or not, but from my experience, I just don't see this getting talked about. What you're kind of referring to, Patrick, and what I would kind of describe it as, I've written a little bit about this in the newsletter, is just a total paradigm shift of geopolitical organization, which of course folds in, the monetary system itself. I think everybody who's kind of been investing recently, like let's just call it the last, 20, 30, 40 years, is very accustomed to a very particular set of underlying conditions. And you kind of been lulled into this sense of security where, you can almost buy anything in the last 40 years. If you would just buy the index, basically the S&P index, the last 40 years, I mean, you'd absolutely crush it. Where investing, I think, for the last 40 years has been comparatively easy because of certain underlying circumstances. But and one of those being general U.S. hegemony geopolitically. We've been kind of in a unipolar world, meaning just there's been kind of one pole of exerting the most geopolitical monetary influence, which is the U.S. Pretty undisputed. But then in the 90s, you kind of start, like, China opens up, and you kind of start having this ascending power of China. And now we have all these. We're kind of in the beginning of the emergence of a multipolar world, where now, Patrick, you rightly point out, China and Russia are kind of coming to their own agreements. You have Iran, Brazil, that people are starting to wage almost like a shadow monetary war, where these other countries are chafing against sort of U.S. dominance as the global reserve currency, and how the U.S. is able to just, kind of exert a ton of influence and coercion as well through their power over the monetary system. And you see China has kind of, built an international payment system that they can use. Russia has as well. And there's an analyst at Credit Suisse who's kind of famous. I'm going to butcher his last name, so I won't say it, but Zoltan is his first name. But he kind of refers to the resource-rich East, Russia, China, and kind of the West that's just totally consumption, buying cheap goods and things like that. And we're kind of coming to a head where, Europe is, gas prices in Germany are oppressive at this point, because Russia's kind of got them over a barrel, because Russia has so much oil, and we're just reaching, Ray Dalio has his changing world order model. He kind of has his long-term debt cycle model as well. And we're kind of reaching the end of a long-term debt cycle and a changing world order at the same time. And so what I kind of think is the biggest risk to investors is sort of assuming that the conditions that allowed the last 40 years of returns to happen, the conditions that basically allowed you to just kind of close your eyes, buy the S&P, wake up 40 years later, a millionaire or whatever. You really have to pay attention to those conditions and make sure they're not changing, because if they're changing, then you might have to change a little bit in your approach. So Patrick, that's a kind of a fascinating set of circumstances that you laid out. I agree with kind of where you were going there.
And I will add one thing. Well, Patrick, you go ahead.
I just wanted to say for everyone that is listening, and for exactly what you said, Logan, is why it doesn't get talked about enough on financial podcasts and people that talk about financial independence, is because it is a tough topic. We're talking about some really big picture, serious topics that a lot of people just don't want to face, and I think that's one of the main reasons that we wanted to have you on, is to just bring that to light for everyone out there. I mean, I understand, like, these are really deep rooted, big topics that, are going to change our lives over the next, like you just said, 30, 40, 50, 100 years, potentially, but it's looking like that. So, I just really want, for everyone who's still listening and out there listening to us, is just, we want to bring this to your radar on the things that are potentially happening out there and how you can hedge against that. And, these are all the big reasons on why you should be hedging against your traditional way of investing. So, James, go ahead. I just wanted to kind of nail that one down.
Oh, 100%. And, I think what Logan is, getting at here is understanding the paradigm shift and putting into context the economy that we have been in for the past 40 years. And let's just take 1971, for example, until now. I love using this example. What did it mean to be a millionaire in 1971? Today, even today, like $1 million, it sounds like a lot of money, but reality, and I'm going to use that word with underline it, real, it's not as much as it used to be in 1971. And in 1971, for all the real estate people out there, you could purchase approximately, hold on to your hats here, about 33 to 36 average medium priced single family homes for $1 million. Today, what do you get? Like 2.5?
2.5.
That's what $1 million has become, based, as a result of fiat standard that we're on right now from 1971 and the debasement of the dollar to today. So you really have to put that in context when you're setting financial goals, because $1 million, and I see this like time and time again on like Twitter and Instagram, like, oh, save $100 a month and 30 years you'll be a millionaire. All right, in 30 years, $1 million is probably going to be the equivalent of $50,000, and what does that get you? So you really have to kind of conceptualize how the world is changing financially and try to work that into your personal financial situation, because it simply is not that easy. And it looks easy on a short time frame, but when you extrapolate it out, you can be risking being left behind.
Yeah, I think that's a great point, James. I see all those posts as well, and I kind of am. To put it charitably, it bothers me so deeply, but because they're everywhere. I think it's tough. And to Patrick's point, it's kind of tough to reorient the metrics that we even use to measure, like we talk about our quote unquote, our FI numbers or whatever. But it's if what we're talking about is basically how the currency itself, what we denominate that number in, the denominator of that number, if we're talking about the health and kind of the degradation of that denominator, then it's kind of, it's sort of a mind warp, because you have to kind of think about it's like thinking about the air that you breathe. I always I'm kind of constantly saying, that wealth is, and I think real estate folks probably understand this better than most, like kind of run of the mill stock market FI folks, is that real wealth is purchasing power. It's not a number on your computer screen, because that number, it can be, a number can be a liar, essentially. and it might not have as much purchasing power as you think it is. And I think too often in this community, the sort of general broad personal finance community, we become very like monastically fixated on this number on the computer screen. And so we don't question the integrity of that number. How sustainable is that? And what does that number actually mean in the real world, in reality, like you were saying, James, in terms of purchasing power? So I think it takes it's kind of a difficult shift in your brain if you start thinking, how much purchasing power am I gaining or losing, or am I staying the same?
Exactly. So, so with Bitcoin, what kind of purchasing power are we getting? How are we hedging against, this inflation, this potential, reserve currency shift throughout the world? Like, how can Bitcoin help us, and how was it designed to help us?
Sure. So I think maybe one interesting way to kind of back into this is a common criticism that I see of Bitcoin a lot recently is folks will say, well, listen, Logan, CPI is nuts and Bitcoin is getting killed right now. What's the deal? How can it be an inflation hedge if we have CPI inflation and Bitcoin is going down? And so I think it's useful to think about, well, what type of inflation are we talking about Bitcoin being a hedge for, and why you should care about that inflation as much, if not more than CPI inflation. And, CPI inflation is just kind of a random measurement of a basket of goods and how much the prices change over time. But the original definition of inflation, the kind of traditional classical definition of inflation, is the expansion of the money supply, the expansion of the number of units of money in the system. And when you expand that is classically inflation. It's relatively recently, and I think we can draw our own conclusions as to why the definition has changed, over the last 30, 40, 50 years. But so if you look at the way that Bitcoin is, yeah, that's right. Well, definitions are changing all the time now, as we know, at a much faster rate. So, that's funny. But so if you look at Bitcoin's performance against monetary inflation, against the change in the money supply, it has performed extremely well in relation to that, as a hedge to that. It's down now, but the Fed has literally come out and said we're trying not to expand the money supply anymore, at least for now, temporarily. So they're saying we are tightening, not loosening anymore. And so Bitcoin and other risk assets and the market generally, because I think the market itself is totally reliant on loose monetary policy now, but has responded to that. So I think it's useful to kind of disentangle what do we mean when we talk about inflation, and how does Bitcoin sort of hedge against that? If you look at, in terms of sort of how Bitcoin has performed over time in terms of preserving purchasing power, if you were to take a chart, for example, real estate, like a median house price over the last 10 years since Bitcoin has existed, and you look at the median house price in dollars, look at that graph, and then look at the median house price priced in Bitcoin and look at that. And I think that's a good example of sort of your purchasing power in Bitcoin is you're accruing more the longer that you hold it. It's a absolutely wild ride. But over its, 11, I guess we're in year 13, I guess, your existence of Bitcoin, you have, if you've held it for more than 3 years, you have accrued massive purchasing power with it. Whereas if you were to hold it in dollars, the graphs are just the exact opposite. The price of homes in dollars goes straight up, in Bitcoin, straight down. And so if you're someone whose view of the world is kind of what we've been talking about, where, okay, we have a lot of secularly inflationary issues. We have issues with the currency, with the sort of hegemonic role of the dollar, and really for U.S. Treasuries as the reserve asset in the current global monetary system. If you think that that system is kind of fraying and struggling and potentially in a transition phase, and if you think that the Fed is going to be unable to sustain quantitative tightening for any prolonged or protracted period of time, then you're kind of looking at Bitcoin as, okay, this is clearly the best way to store value, or if past holds true, is the way to store value into the future. The Fed, with respect to easing versus tightening, I mean, they've tried to stop easing multiple times in the last. I've put this chart up, I think, in a few of my newsletter issues. They've tried to stop easing multiple times in the last 10 years, and they can't do it. It's like trying to quit an addiction. It's like if you're an alcoholic and you try to stop drinking you might be successful for a few weeks, month, year, but it's hard to be permanently off. And especially when the system, or as the analogy, would go, your body becomes so dependent on it. So if you're someone who thinks, like I do, that there's no way, because I think it also becomes a national security issue, there's no way that the Fed can tighten for a sustained period of time and not return to easing, then you got to look, okay, what is that going to do to the currency? It's going to continue to degrade it. It's going to continue to, we're going to continue to struggle geopolitically with, supply chains continuing to be disrupted as we try to onshore stuff, because, we have Russia and China. Obviously, you don't want to be dependent on a country like Russia for oil. All that stuff is secularly inflationary for supply. All the Fed can do is control demand. And so you're looking at kind of the world shift before your eyes, and you're thinking, okay, where can I store my value that gets me from point A, which is where we are currently now, sitting kind of looking across this canyon of change and transition. How do I get my value from here to the other side of whatever transition that we're going to undergo? And that transition might take 10 years, 15 years, 20 years. I mean, it's not happening tomorrow. It's not happening at the end of the year. And so I think, it's useful to look. I know we've kind of been talking about a lot of big picture stuff and big concepts, but it's important to kind of get that view of the field from a 30,000 foot view.
So when it comes to conceptualizing your personal finances and kind of wrapping your head around an adjusted for kind of what a common mindset might be, denominator, could you walk us through the differences between Bitcoin, maybe gold, and then fiat as it relates to being your unit of account? And what I'm trying to get at is the scarcity element, like the scarcity and inflation rate of gold versus scarcity and inflation rate of Bitcoin, what that looks like over time, and why that's a guaranteed, or maybe not guaranteed, but a more understandable unit of account for figuring out a denominator.
Sure. Yeah. We can think of those three types of money that you just laid out: fiat currency, gold, and Bitcoin. We can kind of think of them as on like a sort of sliding scale of scarcity. You have Bitcoin kind of as the most scarce in the sense that there will only ever be 21 million. I mean, that is the way that Bitcoin is coded. You have gold. Gold is pretty scarce, but you can mine gold. People, that's gold mining is a thing. Some people like to talk about how, in theory, we could land on an asteroid that could be gold rich and find something under the ocean that is like there is gold in the earth.
Well, I think Uganda had a 20 trillion gold pile reserve discovered. I think that was kind of a joke online or something, but people joke about that too.
Yeah,
I think I get an email about that mine every once in a while.
So you got Bitcoin, you got gold. And I don't understand why gold people aren't into Bitcoin, because it's basically just a better version of their thing. It's like, do you want Bruce Springsteen or do you want John Bon Jovi? I mean, you're taking Springsteen every time. Or maybe you're not. But so then you have fiat currency is the next kind of level up, and fiat currency is not scarce at all. I mean, that is, you can create more fiat currency. Especially if you're a country who issues its own currency, you can create that with, literally the stroke of a keyboard. You will put money into like a prime broker's account at the Fed, and then that'll just trickle down through the system. You just created money. And so, looking at, what is the unit of accounts, it's really challenging to think about a currency that is so manipulable in the amount of it that is in the system. It's hard to kind of it creates so much misinformation and kind of price signal that it's difficult to sort of maintain it as your unit of account with any kind of accuracy in terms of it's hard to do with respect to purchasing power, because like I said, it's easy to have if you have misinformation in at the monetary layer, then that misinformation kind of trickles out everywhere. For example, let's talk about, April, May 2020, James, you're talking about, it was a huge turning point for you. And it was for me too. And that's because that was the time where I realized, okay, the stock market is in dollar terms is going nuts. Even though the world seems more unstable and uncertain than ever, and markets don't like uncertainty. So what is going on here? But if you overlay the graph of the S&P in 2020 over the graph of the expansion of central bank balance sheets, which is just a proxy for the increase in the money supply, they're the same line. And so people are holding the S&P thinking, oh my God, like I'm getting rich. This is so easy, buy the F and dip and all that stuff. And, but the currency is actually being degraded at the same percentage as that the S&P is gaining. So you're actually, in purchasing power terms, not getting meaningfully wealthier in purchasing power terms, dollar terms. And so I think that, that's really confusing, and that is sort of difficult to think about. And you're thinking about the health of the denominator, what you're denominating your wealth in. And so I think that's a challenge, because most people think, oh, all I have to do is beat CPI inflation. If CPI inflation is 2%, all I gotta do is beat that, and I'm winning. But what you really have to beat is, it's a higher number. You have to beat the hurdle is at what percentage is the money supply being expanded every year. That's the hurdle you have to think about in terms of your purchasing power.
Well, I don't know if you have these numbers off the top of your head, but let's try to compare CPI growth versus monetary N2 money supply growth. Like, what is the difference there?
What? Oh, sorry. Go ahead, James.
Yeah, what's the difference between those two numbers, like CPI and then the monetary expansion?
Sure. Yeah. So, the difference in numerical terms, just to give people kind of a rough sense of what the difference would be, it'd basically be like, the last 5 years, think of like 2% versus 15%. I mean, that's how CPI versus, and those are rough numbers. Charlie Bolello just put out a chart today on Twitter. I'll try to send it to you guys for the show notes, where he kind of shows the percentages increase, decrease of monetary of M2 over like the last 20 years. You can kind of get a good sense of it. But just, CPI inflation, that number has been relatively low, 2-3% for like the last basically 20 years until recently, until the last year and a half. But the money supply growth is just, it's a different story. It's a whole order of magnitude different. And so, yeah, we're talking more than double CPI. Although right now, it's a little different currently because CPI inflation is quite high. But CPI is also a pretty flawed number.
Here's one of my kind of curveballs here, is that, there's only going to be 21 million Bitcoin. There's 17 million something right now. What they believe to be in circulation, people have lost a lot. So we don't actually know the circulating number, but we know that the entire, Bitcoin market cap is less than $1 trillion. So, we're saying it's decentralized, but why can't someone like, Blackrock just go out there and buy up, 51 or 60% of all of the Bitcoin and do the same, monetary manipulation that they are doing in the stock market?
Yeah, that's a good question. So BlackRock, in theory, they could go buy as much of Bitcoin as they want, like lowercase Bitcoin, the currency, as they want. But no matter how much of the lowercase Bitcoin currency that you hold, no matter how many coins that you hold, you exert the same amount of influence over capital B Bitcoin, the protocol itself, as somebody who holds, 1/1000th of a Bitcoin, which is to say 0 influence over that. So in fiat world with fiat currency, I mean, I think we're all pretty familiar with kind of the rich get richer type of a deal, in the sense that if the wealthier you are, the more capital you have, the more opportunities you have. You're a accredited investor. You can just do more things. You have more opportunities. You're closer to this sort of money spigot, so to speak. With Bitcoin, it's totally different. Nobody exerts more influence than anybody else over the protocol itself, no matter how much money or how many coins, that you hold, which is actually, I think, it's a fundamental difference between Bitcoin and and any proof of stake cryptocurrency, which is what Ethereum wants to move to. It's kind of what some of the other popular cryptocurrencies they use a different, they're called consensus mechanisms, but Bitcoin is singular, or is soon to be quite singular in that regard, in the sense that it doesn't create equality in terms of everybody's going to get distributed the same amount or anything like that, but it's everybody has equal access to it. Everybody has an equal ability to go buy some Bitcoin or hold some Bitcoin, and everybody exerts the same influence over the protocol, which is none. Nobody can vote to increase the money supply or do weird stuff with it. Blackrock can't come in and just start governing it in a different way.
Yeah, I mean, we've talked a lot about why people should think about investing in Bitcoin, and I kind of want to talk about some of the misconceptions or some of the pain points that people have on why they haven't invested in Bitcoin, or why people talk about not investing in Bitcoin. So I think that right there was one of them. There is another one, which is, I think they said, by they, I mean out there on the interwebs, that if you are able to acquire 0.21 Bitcoin, then there's not enough Bitcoin for every person in the entire world to acquire 0.21 Bitcoin, right?
I don't know what the population of the world is, but that's
7 billion.
That's probably true mathematically.
So, for you to be one of the top holders of Bitcoin, you only need to acquire, less than a quarter of a Bitcoin for one. So for all of you people out there that are investing, if you could just get to a quarter of one, you have the opportunity to, be one of the top holders. So that's very interesting out there. Another thing is talking about the ability to trade and not having to acquire a whole coin. I mean, I think a lot of people, when they think about cryptocurrency and Bitcoin, they think you have to buy a whole Bitcoin, and it's just kind of like stocks where you can buy, shares, small pieces. And if you could break that down a little bit for us on, how small can it get? Because a lot of people out there, maybe they've heard of Bitcoin, they know people that have invested, but we've talked about the big picture a lot. And now we talked about some of the positives to hedge against the inflations, but let's try to, take some of those common misconceptions that a lot of the people listening to this probably have, and, try to ease their anxiety on that a little bit.
Yeah, I love that. I think this will be great. So yeah, it's definitely a common misconception that you need to purchase a whole Bitcoin to sort of be meaningfully invested in Bitcoin. Certainly not true. Bitcoin is actually, we could actually make it even more divisible than it is now. Every Bitcoin, is composed of 100 million. The smallest unit of account right now is called Satoshis, named after the pseudonymous creator of Bitcoin, Satoshi Nakamoto. So every Bitcoin, one Bitcoin is 100 million Satoshis. You can continue to, make smaller and smaller denominations as well. But you certainly do not, again, we've talked a lot about how, the purchasing power of Bitcoin has increased so dramatically over the last 12, 13 years. If you think that's going to continue, then you certainly do not need to be holding out, waiting to get one Bitcoin. You can actually dollar cost average into Bitcoin, buy, some Satoshis every week. There are different services that allow you to do that. In the same way, that you would dollar cost average into, say, your Vanguard account or something like that. And so the kind of the infrastructure around it that is allowing people to invest in it and kind of interface with it and sort of get into the spaces is improving kind of on a monthly basis, almost certainly a yearly basis. But yeah, definitely, if you're somebody who's thinking, oh man, I'll never have a whole Bitcoin, most of Earth is never going to have a whole Bitcoin. And that doesn't mean that you've missed it. It doesn't mean that you don't have a meaningful amount. A lot of folks think that you could have 1/10 of a Bitcoin or 1/100th of a Bitcoin, and the value, the purchasing power of that is in my opinion, not financial advice, going to increase over time if you're willing to kind of hold it through volatility.
So let's talk about another misconception, and it's not much of a misconception. It's pretty much truth as it relates to Bitcoin, the volatility. And it's either one of two spectrums of it. And you always hear the feedback from people who maybe don't appreciate Bitcoin for what it is. It's either always too expensive or it's dead.
It's going to zero.
Yeah. So it's no, it's almost no in between. It's either a Ponzi, scam, too expensive, and it's going to crash, or it's dead. Like right now, it's dead. I think we're just bumping along from 17,000 to like 23 or something right now. So talk to us a little bit about the volatility. And I will say, there is expression in Bitcoin world. I love following Bitcoin Twitter. Some of the most smart, intelligent people, but also the meanest people you'll ever meet. There is a saying: you get Bitcoin at the price you deserve. It kind of is what it is, but you just got to take the time to learn about it. So talk to us a little bit about the volatility and like how someone can kind of come to grasp with that for better or worse.
Yeah. So this is a big one. I get this one a lot because it's scary, right? I mean, the volatility is intense. I mean, it is intense. If you're kind of experiencing it for the first time, I think it's really jarring and can be an emotional roller coaster.
Patrick has been there.
Patrick is, Pat, you've probably, aged yourself unintentionally.
I was going to say, even if it's the second or third time, it's still never, gets easier. But after the first time, you're at least like been here before. Oh,
this is a beating that I can take. Yeah.
What,
so
70% of your portfolio?
Right. So the way that I think it's useful for folks to conceptualize this is to kind of compare it to, if you look at Amazon and kind of the first, or even Apple, if you look at Amazon kind of from, late 90s to like 2010, I mean, Amazon had multiple 80% drawdowns. I mean, honestly, a chart of Amazon from like 97, it looks like a chart of Bitcoin. Same with Apple. I mean, and I think it's kind of a testament to like emergent technology that is kind of polarizing, that people don't totally understand what it's doing. So you don't have, if you don't have kind of a mass of people who understand what's going on with it, there's some mispricing there. And so you get these just wild swings. But I would definitely encourage folks to look at a chart of Amazon, or just Google Amazon, drawdowns over time. You'll find some pretty fun charts. So in some ways, volatility is sort of, people say volatility is the price of returns. I don't really think that's super helpful. I think it's true, especially in this case, but I think, something you were saying earlier, James, I think factors in here as well. I mean, Bitcoin is kind of in the process of demonetizing other assets and sort of taking some of that monetary premium away from other assets. And that's a process. It's not a straight line. It's not going to be a straight line. Bitcoin has been around for 13 years. And it's gone from literally no market value at all, $0, did not have a market price, to right now, whatever it's at now, and 20 couple thousand. And we are very much in the early stages. Another chart I would invite people to look at, this one's a little scarier, but your listeners might be familiar with Weimar Germany and hyperinflation in the early 20s, and that's hyperinflation is kind of the worst of the worst currency degradations, when you're kind of debauching the currency and you're debasing it constantly at an accelerating rate, you get hyperinflation, which is when, you know, you're carrying a wheelbarrow around of the money. But if you look at a chart of gold, you know, priced in German marks in Weimar, Germany, it looks absolutely insane. But I mean, it looks totally wild. Kind of looks like a Bitcoin chart. But at the end, you know, it is actually, it's the moon at the end. Basically, it's off the chart at the end, because it was basically people were kind of transitioning out. People realized, okay, the German market is not holding value at all here. We're jumping into gold. And I mean, I'm not somebody who's like subscribe. I don't think we will get to there are people I respect a lot who think we're going to hyperinflation, but that's not my position. I don't think that's where we're going. I think more likely we go to a world where Bitcoin is, you know, takes some market share from kind of central reserve assets as one of several different assets that are used, which I think will increase its market cap significantly. But yeah, so just to kind of to wrap that answer up, you know, there's certainly historical precedence for this type of volatility for something that is demonetizing other assets that have been accruing monetary premium to them. And I do think looking at emergent tech, you know, going through the .com era, Amazon, Apple, it's useful. If you think of how many people held Amazon from like 96, 97, all, you know, through all of that, through like a 90% drawdown, multiple 80% drawdowns, it's probably just Jeff and his buddies.
Mm-hmm.
Yeah. So we, you know, on the topic of monetization, I think a helpful way to think about it is monetization is basically a way to conceptualize money. And right now we've had a whole bunch of assets across the board, from stocks to real estate, becoming monetized, meaning a substitute for money. And I think that, you know, either way you slice it, whether you're a gold bug or a new technology adopter and embracing something like Bitcoin, I think what you're ultimately saying with your monetary vote is you think that things should perhaps have a utility value, like real estate. You know, maybe it shouldn't be impossible for somebody who's 28 to buy their first home in a DC suburb, because prices are now more than $750,000 for a starter home. Maybe there should be a utility value, and like it should cost closer to what it's worth to just live it, and not being used as a store of value for Blackrock to dump a whole bunch of cash because they'd rather get the cash off the balance sheets and they can get cheap leverage. So, you know, whether you're looking at it in gold terms or whatever, like I think that's the bigger picture issue, is understanding how holding dollars might be damaging to your long-term financial wealth. But, you know, stepping back from that a little bit, how do you manage an allocation to Bitcoin? We talked a little bit about dollar cost averaging in an exposure that way, but like, how do you kind of gauge, you know, what a proper allocation might be for a portfolio? And I know you're not giving like financial advice, obviously, like maybe don't sell everything you own and buy Bitcoin, like, you know, but, you know, how would somebody conceptualize that and, you know, kind of determine what the risk tolerance is?
Yeah, I think, you know, there are certainly some ground rules I think everybody should have in mind before you buy any Bitcoin, if you're thinking about buying it. I mean, first of all, never, ever, ever use leverage, you know, for Bitcoin, or, you know, crypto generally. I know leverage is very useful. I mean, you guys are like savants with leverage in the real estate game. You know, but with Bitcoin, it's like the swings are too much. You don't want to sort of lever up, you know, on something that can take an 80% drawdown with some regularity. So I would just say that should not be something you're thinking about. Second of all, you know, have an emergency fund. Don't, you know, make sure, don't take your emergency fund and buy Bitcoin with it. Have an emergency fund. To be a smart, sane human being with an emergency fund. You know, and, you know, have some other sort of assets as well. So, but once those kind of ground rules are covered, then I think your risk appetite is kind of at that point, you know, just tied to, usually it's kind of, it goes up, in correlation to, you know, how much time you spent, you know, learning about Bitcoin, what's your comfort level with your understanding of it, with the macro environment in which it would be successful. And, you know, I think it's important to, you know, again, not financial advice, but, you know, I think getting off zero, getting a little skin in the game usually encourages you to learn some more. I mean, I think you guys probably agree that, you know, the best way to probably ultimately learn, you know, you can only learn so much about real estate before you actually go out and kind of do some of it. And I know, you know, Patrick, you said in the last episode, you know, kind of you in the beginning, you didn't really feel like you knew what you were doing. You were kind of just out there doing it, and you were learning about it. I think it's important to get some skin in the game, but I think it should be small until you have developed the allocation. I think should be small until you develop, you know, a sufficient level of understanding to feel comfortable, you know, with potentially increasing it. And it's really easy to get FOMO in the space. It's really easy to chase in the space. And I would tell people, advise people, if you feel like you're chasing, don't chase. You know, set up a dollar cost averaging program. You can do that through multiple different platforms. I use a platform called Swan Bitcoin for it. It's very easy to use. I think Coinbase lets you do it too, recurring purchases, but their fees are higher. So I would, you know, point people to Swan. That's a Bitcoin only platform, and no affiliation with them. I just use it myself. But that kind of takes the sort of FOMO element out of it. This is a space where people get amped up pretty quick. You're going to make bad decisions if you're chasing. So I always try to tell myself, you know, be early, but don't be hasty, you know, and just don't chase. Just have a plan, have a strategy. And once you get some skin in the game, just dive down the rabbit hole, learn about it. A lot of great resources out there. And then, you know, you can always adjust your allocation. But don't try to hit a home run in your first at bat.
Right. And I've got a good rule of thumb for that. It's the sleep at night test.
Yes.
Your body and mental energy will tell you what your risk tolerance is. And full disclosure here, first getting in Bitcoin, like I went way heavier than I probably should have. Never sold any, proud of that fact. But I did lose some sleep at night with some of those drawdowns because I was just getting used to the space. But you know, I think all in all, like your body's going to tell you like where you should probably be. And I agree 100%. It's your tolerance in any investment should probably be on the correlation of time studying it and then time in it. So like real estate professionals like have been in real estate for a long time. They can take more risk as they go on with development projects and things that are kind of out on the edge. Same goes for Bitcoin. Like, you know, at least dip your toes in your first Bitcoin purchase or your first single family real estate purchase. But as you learn more and you become more of an expert through experience and doing, you know, take some risks because ultimately, you know, you get paid for risks in this game of life.
Mm-hmm.
So
yeah, and I would say it's important to keep your time horizon in mind as well. I mean, I kind of tell people like, if you're not planning to hold Bitcoin for like minimum 5 years, then don't buy it. You're gonna get whipsawed around, and you're not gonna have a good time. You're probably not gonna learn anything. You got to make a deal with yourself that I'm not touching this thing. I'm not selling it for minimum 5 years, and just kind of that. I think that encourages like a longer time horizon, which is important with kind of an emergent technology like Bitcoin.
I couldn't agree more. As someone who has done all of the things that you just said not to do.
Well, that's the thing, Patrick. You got to learn from experience, man. It's a trial and error system here.
Yeah. So as someone who has used
copious
home equity line of credit money to buy Bitcoin, as someone who invested, you know, when I was making like 60 grand a year, invested like 40 or 50 grand into Bitcoin and other cryptos. I mean, I can remember, like you said, it gets crazy. I can remember watching my portfolio go from 7,000 to 60,000 in like 3 months when everything was going crazy with all the altcoins and all the other things. Not Bitcoin, but in the crypto space, it does get really exciting. You think the roller coaster is just going to keep on going, and you're the smartest guy you've ever met in your entire life when you look into the mirror. And like James said, invested too much to where if I was waking up and rolling over in the middle of the night, I was checking my app to see, how much I was up or down, or it was absolutely insane. So I highly, highly recommend just setting up an automatic, you know, allocation, whether it's 25, 50, $100 every paycheck, once a month, and just set it and forget it, like you said, and not worry about it. I mean, if I would have just held on to all of the crypto that I bought over the last 5 years, I would be way more ahead. Instead of being down tens of thousands of dollars, I would probably be up hundreds of thousands of dollars.
I was going to say, I've got another test, and I think Patrick could probably speak to this one a little too, because I remember you talking about this before, is, aside from the sleep at night test, it's the wife test, the family test. Like if you are managing some family money or couple money or whatever it is, maybe don't bet the farm on something that would make somebody else who's a part of your financial independence journey nervous or scared. So that, it's another thing to consider.
Yeah, I mean, if you are not willing to be able to sit down and have a conversation about losing, tens of thousands of dollars, then don't sell, just hold, and don't invest more than you're willing to lose. I think that's one of the keys that everybody always says is don't invest more than you're willing to lose, and don't invest any money that you're going to need in those next 5 years. Like if you get up to a portfolio that's, significant, and you get into a pinch, that's not the money that you're using to get into that pinch. That's why you need to have your emergency fund. That's why you need to have your other investments, and use this, like you said, as a long-term hedge. And I'm willing to be the punching bag and the voice of reason here and just say, like, I've made all of these mistakes, and you know what? I still believe in cryptocurrency. I still believe in Bitcoin. This conversation has, made me even solidify that even more. This is a topic that is talked about and in the news more and more over the last few years, but there's not a lot of people in our particular space that are talking about it to a level that we really wanted to talk about it, today, and just make people aware that it is a good investment. We've spelled out a lot of the reasons why it's been a good, or will be, and is a good investment, and how to do it safely, responsibly, to help hedge and go along with your entire financial independence and retirement portfolio. I don't think, you need to be 100% all in, but it would be nice to allocate some. I know for me, I've been trying to get, my father into investing in Bitcoin, and he tells me all the time. I asked him, I said, hey, invest $10,000 back in 2017. I'm like, just give me 10 grand. We'll buy a couple of Bitcoin. And when it hit like 60,000, he texts me and goes, that's one of my regrets. I totally wish I would have, did it. And even now when it's at 20, he still would be up. So like you said, long-term hold, but, definitely think about it as part of your portfolio, your allocation, and all of that.
If you've got a boomer that you're trying to convince to buy Bitcoin, I know there's a great segment by Michael Saylor on Fox News talking to Tucker Carlson. And my dad was watching that one night, and he literally called me that night. He's like, I think I need to buy some of that Bitcoin. So we got my dad into Bitcoin because of that. And I thought that was kind of funny.
Well, I think after this episode, I think a lot of people are going to rethink their strategy, because
if nothing
really
else, like, people should appreciate that we're bringing this to light in the midst of a market time when you would look really stupid and silly to buy it. And it's a contrarian play right now. And it's great to buy it when it's on the way up. and everyone is euphoric, but step back from the chart, look at what Bitcoin is fundamentally, and as we've talked about this whole conversation, as a unit of account and as your denominator, and look at it as like, how can I get a piece of this network, rather than just watching the dollar value.
Yeah, to put it in, speaking of Michael Saylor, and this is a real estate kind of comparison. I mean, he has framed it before as, if you think about buying a block of Manhattan like 200 years ago. So another way to think about it in terms of time horizon, and just kind of putting it in terms that are maybe easier to kind of conceptualize.
I love it. Well, James, I think it's time to get into the last part of our podcast. We're going to go with the same questions because I think they're definitely going to work here. So let's get into the big four.
So,
all right, James, kick it off.
Let's take it away. So, Logan, I want you to tell us something that you consider a financial independence hack, something that just seems like a cheat code that you do that's really setting yourself up for the future and your financial independence journey.
All right, yeah. So I was thinking about this a lot. I was thinking, what's my biggest hack? I think the thing that's been most useful, the thing that I think makes everything easier in terms of a financial independence journey, is how aligned are you with your significant other, your spouse? I'm married. I have a very young child like you, James, and my wife and I, we talk about our financial plan all the time. We couldn't possibly be more aligned, more on the same page. We have a strategy. We, in a disciplined way, very disciplined way, execute the strategy. We check in on the strategy. We have sort of numbers and goals along the way, sort of like short-term, I guess, KPIs sort of that we're looking to hit. And I can't, it's hard for me to even imagine being effective on a journey to financial independence if the person that you are living with and that you're partnered with, if you are not totally aligned, transparent, and just on the same page. And so I think for me, my relationship with my wife is, I think that's kind of our superpower together.
Bravo. That is the first time we've gotten an answer like that. And I have to say, I'm pretty biased, but I think that was the best one. Your partner has to be aligned with you, no matter what it is. And I love how you said you guys go after your key performance indicators on a regular basis to make sure that you're going through your goals. So, man, that is fantastic. Well, we call this next one resources, and I have a feeling you're going to have quite a few that our listeners probably have not heard of, but is there any books, podcasts, or people that you would recommend for our listeners to check out that have shaped your investment strategy and your financial independence journey?
Yeah, this is a tough one for me because I had so many. But I think for me, the people who shaped my personal finance journey the most early on were people who were kind of giving away free information, the Mr. Money Mustaches of the world, that sort of thing, mad scientists. And I know that everybody is familiar with them, so those aren't my recommendations. Those are my kind of early influences. Like we talked about, my journey has changed a little bit since mid 2020. So in terms of a lot of the macro stuff that we've been talking about, I just want to give the listeners some good people to follow on Twitter who are constantly talking about these macroeconomic issues. Three really good ones are Lynn Alden is a great one, Luke Groman, fantastic, Darius Dale is great as well. So those are kind of just good macroeconomic people. If you're looking to kind of see the bigger picture, a lot of the stuff that we've been touching on, those are great follows. In terms of Bitcoin stuff, if I were to give people 3 books recommendations for Bitcoin, the three for me that I think had the most influence were, Saifedean Ammous's book, The Bitcoin Standard, is pretty classic. I think a lot of people have heard of that one. But I think if people are interested in getting a sense of how the technology works in a way that's friendly, layman terms, I'm not a software engineer. So the part about Bitcoin that was hard for me to kind of get initially was the tech. So there's a book, it's actually available for free on the internet, I think on Swan Bitcoin's website, by a guy named Jan Pritzker. It's called, I think it's called Inventing Bitcoin. It's very short, it's like 100 pages. And he kind of just describes how Bitcoin works from a technical perspective. That's extremely useful. I've revisited that book many a time. And then the third one would be, there's a book called Layered Money by Nick Batia, Bhatia. And he has a Substack now as well. And that's just kind of about the layered money system, the monetary system that we currently have, with reserve assets and sort of fiat money tied to reserve assets. And so those would be my Bitcoin book recommendations. If I had to give one podcast recommendation for Bitcoin, I would say there's a series on Robert Breedlove's What is Money show. He did 10 episodes with Jeff Booth. It's kind of, maybe it's kind of in his early episodes of the show, but the Jeff Booth series, I think if people are looking for an introduction to why Bitcoin is important in terms of, the world is changing and how Bitcoin fits in, just listen to Jeff Booth talk for 10 episodes. And I think that's helpful. And lastly, I would recommend, if anybody wants to, I write a newsletter every 2 weeks that, I try to, in addition to my own takes, I try to connect people to a lot of the best content in the space, because there's a lot of crappy content in the space and it's kind of hard to distinguish between the signal and the noise. So I'm sure we'll mention that. I'll mention that on the sort of the last thing we talk about, but that's called Think Bitcoin. And other than that, I mostly listen to fitness stuff, and I read a lot of, I'm still an English lit nerd at heart. So I still read a lot of, F. Scott Fitzgerald and stuff like that.
Well, your appreciation of the English language comes out in your writings. Like I've read a lot of what you've read, and it's phenomenal stuff. Very deep thinking pieces, and we'll get all to that in the next question, or one of the next questions. But Logan, it's the future you. Like it's 5 years in the future. Maybe give us a Bitcoin price prediction alongside with telling us where your life is personally and also professionally.
All right, Bitcoin price prediction. I don't want to get myself in trouble. 5 years from now, I will say $200,000 a coin. 5 years.
Now,
I don't want to be quoted on that. Don't hold me to that.
We won't.
No, but more importantly than what Bitcoin's worth. Like, tell us about your life and what things are going on for you personally and business wise.
Well, I hope at that point that I will have been working full time in the Bitcoin space for several years at that point, hopefully doing my part to educate as many people as possible and sort of connect with as many people as possible about Bitcoin, and hopefully just kind of being a part of the movement to use Bitcoin to create a better world, a world that's more kind of that has more fair financial access for more people. Hopefully we're increasing the aggregate amount of happiness in the world and fulfillment by just making our monetary system better. And so I hope I'm working on that full time. I hope I'm traveling a lot with my wife and my daughter and getting to spend a lot of time with them. I think everybody who's chasing financial independence, wants to have that flexibility, that optionality, and spend more time with the people you love, be able to do things that make you happy, because we have a finite amount of time on this planet. So that's where I would like to be.
Truth.
I love it. I absolutely love it. Well, Logan, I have to say, it's been an absolute pleasure and an honor to have you on our episode today. I know we switched it up a little bit, but James and I are really passionate about this type of stuff in our financial independence journey. And we want to bring you guys a ton of different guests like Logan. So Logan, where's the best place for people to find you? Tell us it all.
Sure. Yeah. So I write a free newsletter, goes out every 2 weeks. It's called Think Bitcoin. You can find that it's on Substack. So it's thinkbitcoin.substack.com. So check that out, subscribe. If you're new to the space, I think we're on issue 39. The first 5 to 7 issues are very, very beginner friendly and are meant to kind of get people up to speed pretty quick. So check those out. I'm pretty active on Twitter as well. My handle is at the Y of Fi, so FI. That's the same handle on Instagram. A little less active there, but still on there. And I'm now following the rental couple on Instagram. So, but yeah, so mostly Twitter and the newsletter, and feel free to reach out, and happy to field questions. My DMs are always open. Yeah, always happy to chat about Bitcoin or macro or any of the things we discussed today.
Fantastic. All right, guys. Well, you guys know the drill. If you like this episode, if you hated this episode, please leave us a comment, shoot James an email. He's the one that gets them all. Make sure to subscribe on YouTube. We only have like 50 some subscribers. So please subscribe on YouTube, leave us an Apple review, check us out on Spotify, visit the new website, and we'll catch you next time. Thanks a lot.
Thanks, Logan. See you guys.
Thanks, guys.
Thank you for listening to the Real FI podcast, where you learn from the investors that have lived the hard lessons for you. To connect with us during your pursuit of financial independence, be sure to join our community by following us on Instagram or emailing us at info@therealfi.com. If this content made you financially, mentally, physically, or spiritually richer, please make sure to leave us a positive review on your preferred content platform. Cheers to kicking the 9 to 5.